Hello everyone, welcome back here to a new video here on Activities. Today we're going to talk about the macroeconomic report that was released last Wednesday. I'm also going to talk a little bit about the meta report that came out Wednesday, since we did a meta evaluation video just this Saturday. So that's what we're going to talk about this video. First, I want to start off with a minor disclaimer here that this video does not constitute as financial advice, and I'm not a financial professional, I'm not an economist, I'm nothing of that sort. I'm not licensed to give you guys financial advice. So I would recommend, if any of you guys would want financial advice, to contact a financial professional. And I don't do this as a team. I'm not financially liable. I'm not liable in any way, actually, to any things that you do. That is any actions you take based upon the information in this video. So if you take this video as advice and you use it to reason and base an investment decision on, then realize that I am in no way, shape, or form liable for anything, not even the information provided in this video. I try to make it, of course, true, right? Only the information provided. I try to fact check and make sure that all the information is the truth. However, of course, I could always have a misstep. I could always have a just some blatantly fake news or report some wrongful data. Could happen. I try not to, but it could happen, and thus I tell you guys I'm not liable for any information provided in this video. Okay. So always double check the data, even I provide. Okay. Always double check it. Look up the reports yourself and whatever. I didn't make a separate slide for the meta video, for the meta part. I just want to talk about a little bit of the meta report, and that is that Meta's report is just phenomenal. I mean, net income grew 20%, not even 20%, they beat it by 20%. They beat the estimations by 20%. I think the EPS came in at about $6 something, just tremendously higher. Even I expected about an EPS of $5.33, which was already higher than analyst expectations. So they beat that by a wide margin. CapEx came in lower than expected. That is the CapEx spent in Q1. Now the CapEx guidance for the rest of the year was kind of the thing that makes a lot of investors concerned. Given that they right now have upped the guidance by about 10%. Okay. But the rest of the guidance was just good. Costs are expected to go down a bit. Revenues are expected to be a little bit higher. So overall, the guidance is very good. At first, what I thought was maybe they wouldn't give any guidance in the fashion that Snap did on Tuesday, where they said, like, we're going to give guidance during the earnings call, which made me expect that probably the stock would show some red numbers, but that didn't happen, luckily, and the stock increased significantly. That is about 5%. I must say, though, personally, I do think the markets responded a bit underwhelming, because when you beat estimate earnings, right? Estimate EPS or expected EPS by about a 20% margin. I mean, come on. Does that warrant a 5% increase in stock price? If by any metric right now we still have a positive net present value, meaning that it's still considered a buy, remember, not financial advice. So I don't know. I'm looking into maybe buying some extra Meta platform stock. If maybe the stock retraces a bit. I still hold about 20 shares, by the way. At the peak, I had about 50 shares, but I sold at about the Q1 release, I believe. Earnings report, that's about 670. I think I sold that. So yeah, I'm just gonna hold my 20 shares, and maybe it will do something, maybe it won't do something much. If it retraces a bit back today, then I might consider buying some significantly bigger portion, because I mean, just looking at the fundamentals of the company, it's just phenomenal, and what the product pipeline is with regards to AI and how they're going to utilize that to make ads even better, and also make the whole experience for advertisers better, not just the consumers but also for advertisers. Remember, advertisers are the real customers of Meta. It's not the consumers who use it. The consumers are the product, quite frankly, and the advertisers are the customers of Meta. So because they buy the ad space. So and what I'm seeing there is just overall that the ads, the product experience for advertisers is improving, and the amount of consumers just keeps on increasing. Once again, we're at 3.4 billion. Even DAP, daily active people, even blew me right away, because I thought maybe a little conservative 5% year-over-year growth in the daily active people. Mind you, they have more than 3 billion people already daily active on their platforms, but it even increased more than that, so I was even surprised by that number. Head count came in a little higher than expected, but whatever. They say they need that to further their AI development, which I think is not necessarily bad. So overall, for me, it's a tremendous earnings report. I'm very happy as a Meta investor. It's also one of the reasons why, for individual stock holdings, it's by far my biggest position. It's about double. Double. It's almost twice as big as my second position as an individual stock. My biggest position is still in the S&P 500, just an index tracker. Okay, keep that in mind. Okay, well, let's just continue with the financial, or with the macroeconomic report, because that's very likely why you came to this video, of course. So the headline was real GDP declined 0.3% year over year, mainly driven by a big increase in imports, and the PCE price index is at 3.6% year over year. Well, the thing with real GDP in this report was that actually GDP somewhat increased, but because companies wanted to be a little bit ahead of the possible tariffs in April, mind you, this is Q1, so that's January, February, March, they bought a lot of imports, or they imported a lot of goods. So that's something to keep in mind. But actually, if you factor the imports out of the equation, real GDP did increase. So personally, about the real GDP decline, I'm not really that concerned. Because, well, a big factor is the imports, and the rest all just looked pretty healthy. The thing I'm more concerned about is the PCE price index, which is at 3.6% year over year, which is just way higher than I would have expected. I would have expected, you know. So, what does this warrant? A possible stagflation scenario? I don't know. I don't see real GDP declining at 0.3%, driven by those imports. I don't see it as a big concern. But we'll have to see what Q2 brings, right? If that also declines. We actually faced a recession scenario in 2022, and the stock market did pretty well during that whole period in 2023, eventually in 2024. So if the short-term history at least is something to go by, you should be investing all your money in the markets right now. But anyhow, how do we hedge ourselves against stagflation risk? Well, stagflation, of course, are two parts, right? It's inflation and it's macroeconomic downturn. How to hedge against inflation? First, well, low-cost debt, this leverage, tends to be a very solid way of hedging against inflation, simply because you completely eliminate inflation on that part of your portfolio. Mind you, the inflation risk is the risk for the debt giver, not the indebtor. Okay? How do you say that? Well, anyway, the person who gives out the debt, he faces the inflation risk. So, but of course, as a general rule, you would want the cost of debt to be lower than inflation, and that tends to not happen very often. There are very few debts who are cheaper than inflation, simply for the reason that, well, why would you give out debt cheaper than inflation, right? I mean, you actively lose purchasing power. So it doesn't make any sense. There are some institutions, some people who do that. Some people are just ignorant and they don't know any better. And some organizations or institutions, well, sometimes they don't know any better either, but it's also because sometimes they lend out other people's money. So what you see, for example, a lot, and I'm in Europe, I live in Europe, and that is where interest rates tend to be quite a bit lower than in the US. But banks, for example, they give very cheap mortgages. Even at a time, I think it was a couple years ago, they gave mortgage at an interest rate of 1.5% per annum. So that's incredibly cheap, even way lower than normal inflation, right? Because normal inflation is 2%. How can they do that? Well, quite frankly, what people seem to get wrong is that banks don't lend out their own money. They lend out your money. You have your money on the bank or in the bank. You save it over there, and they lend it out. It's not their money. So the real people who are losing money in this deal are the people who store their money in the bank with very low interest rates, with a presumed idea that it's 100% safe. Well, it tends to be quite safe, but ask that to the people in 2008. Of course, you're protected to a certain degree, though. So low-cost debt as leverage tends to be really, really good sources to hedge against inflation, because you pretty much just carry over all of the inflation risk to the person who gave you the debt, or even someone else in the case of banks. Other sources of low-cost debt and leverage could be the option market. Okay, and this is something dangerous. I'm warning you guys, you have to really know what you're doing. But if you do really know what you're doing, you could get cheaper debt on the option market, okay? Because that's just how premiums sometimes work. So that could be something to look into. But also, for example, here in the country that I live in, you can get a student loan. For students, that is, of course. No shit. And these loans have about an interest rate of 2.5%. Okay, so that's also cheaper than also cheaper than inflation, at least in the last period. Now the thing, of course, is also what you have to factor in with that is that it could also result in lower costs in general. For example, for me, it's the cost of equity in my country, if I used my own money to invest, would have been higher than the cost of debt. Okay, because in my country, for example, and this is not for the US people, but in my country, and I know, for example, in Switzerland they have this too, you have a wealth tax. So what the government does is every year they just look at, okay, how many assets do you have, how much is it worth, and we're going to take 2% of that. That's just what they do. They don't have any capital gains tax, they don't have any of that sort. They just say, hey, how much do you have? Okay, we take 2%. Okay, it's a very easy system, right? Bookkeeping or accounting wise, it's very easy, because you only have to know how much you're worth at the 1st of January of every year, and they just take 2%. So I can add that to my cost of equity, and also add inflation, and well, then I get my cost of equity. And cost of debt, even at, for example, brokerage firms, can be lower than that. Okay, so that is something maybe you could also look into. But once again, using debt or leverage in investing is something that you can only do if you really know what you're doing. Okay, don't do this stuff when you barely know anything. Just keep to your own equity maybe, because you can lose more money than you put in with leverage. Okay. Inflation hedged bonds, of course. I think this is quite an obvious one. We also got, of course, buy solid businesses with a long-term time horizon, because the thing is, usually macroeconomic events will eventually fade away. So if you just hold good solid businesses, or the S&P 500 index for that matter, for a period of 40 years, for example, there's not much to worry about here. How to hedge against a recession? You could use put protection, for example. I think it's about 5%. If you put 5% of your portfolio in a put, you can protect 100% of your portfolio against a stock market decline. At least that was the case in January. I looked into doing that, but of course I didn't, because guess what? if I did buy a put in January, then of course the markets wouldn't have declined. That's of course a joke, but now it's something you could look into. You can also buy U.S. Treasuries. Once again, do keep in mind that if you're buying U.S. Treasuries, the risk that inflation will outpace those is decently there, but the U.S. Treasury rate is high enough that you do have some margin on that. And once again, buy solid businesses with a long-term time horizon. So how to hedge against stagflation? Well, there's only one overlapping theme here, and that is buy solid businesses with a long-term time horizon. Now, what does history tell us in scenarios of stagflation? Well, if we look at an inflation-adjusted returns of the 1970s, that was a period in which the US, faced a stagflation crisis. We see that the stock market, inflation-adjusted, performed pretty terribly. Now, if you held on for a decade more, you would have inflation-adjusted once again, pretty much been net zero. So you wouldn't have lost any money. That's why I'm saying the long-term time horizon is very important. Now, what if we don't inflation adjust? Then we get this chart. And you'll see that in that period, the stock market pretty much 3x'd, right? So in case you would have used leverage, and I'm not suggesting anything here, but in case you would have used debt, pretty much fully eliminating the inflation risk, you might have had quite a nice return. Now, do keep in mind that the more that inflation happens, the more inflation we have, the interest rates tend to be higher as well, because of course companies want to adjust for that, or people who give out debt want to adjust for the inflation risk. So that's also something to keep in mind. But anyhow, overall, if you hold for a long term time, then you will generally see quite good returns. Okay, so if you just scoot that graph over to the side, we see that inflation appears to be a bigger threat to real market returns than macroeconomic recession risk, right? Because this is the chart with inflation, right? So we see you're pretty much flat. This is the chart without inflation. Keep in mind the macroeconomic risk is still here, right? The macroeconomic things are still here. So we can see here that inflation is a way bigger risk to your portfolio than the recession risk is. It appears that investors who use cheap debt, that is where cost of debt is lower than inflation, would have had significant returns. Now, of course, once again, you need to be able to get those debts. They do exist, but they're not plentiful. Source for cheap debt, well, quite frankly, just stupid people. Possible collateralized loans, watch out with those though, and the option market. And once again, watch out with those. Can we use macroeconomic data for the stock market? Well, Warren Buffett has released, we have an audio file of Warren Buffett. I'll put that in the description below, where he said that even John Maynard Keynes was not able to use economic data to predict the stock market. Notable examples, of course, Keynes, but also most notably is Irving Fisher, who was simply just a terrible investor, even during the 1929 crash, right? Or during, not even during, even prior to that, he said that stocks had a kind of a permanently higher level. So he said it was pretty much impossible for stocks to decline. Now, of course, we all know what happened during 1929, and he got totally wiped out. He lost pretty much all his money in the crash. So even one of the best economists whose models we still use in economic literature today, think of, for example, the Fisher equation, was a terrible investor. So that tells you something about the use of macroeconomic data. Joseph Schumpeter was also unsuccessful when he worked at the Austrian Finance Ministry, I believe it was, and was leading the bank and investing department over there. You could also maybe name Scholz, who didn't really use macroeconomic data, but he did have a big impact on financial literature. Now, Scholz is, of course, famous from the Scholz equation, when you want to, pretty much price options. And, he was responsible in 1998 partly for the LTCM crash, which was a firm that was, let's just say, a little risky. That is, they were heavily over leveraged. I think it was even they were at a certain point they were 99% leveraged or something, but correct me if I'm wrong on that. It's something I read the history about it. It was something like 99% leveraged, like crazily high in any way. Meaning basically that if your positions decline just a little bit, just 1%, pretty much you're already underwater. Conclusion, pretty much, and once again, not financial advice. Keep on buying solid businesses and hold them for the long term, or you can just buy the S&P 500 and hold that for the long term. Yep. I thank you guys for watching. That was pretty much the video for today. Thank you.